With the markets moving to the next phase of the cycle, how do you create capital growth? Do you have to change your strategy? Today we're going to discuss some of the myths about capital growth and have a talk about what's ahead with Dr. Andrew Wilson, Australia's leading property economist.
Are you interested in property investing, success or money? Well, you're in the right place. This is the Michael Yardney podcast, where each week you'll learn a number of new ideas regarding success, property investment and money in 20 minutes or less. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property advice. Now here's your host, Michael Yardney, who has once again been voted Australia's leading property investment advisor. That's the fourth time he's won a similar award in the last 6 years.
After 5 years of an upward trajectory, we're now seeing affordability constraints, tighter lending criteria, lack of consumer confidence, softening demand, particularly in the Sydney market, but in other parts of the property market around Australia as well. Let's be blunt, we've moved to a new normal, a period of lower growth. And while you may not like how it affects your property plans, the reality is things are unlikely to change for quite some time. Welcome to another episode of the Michael Yardney podcast, and this is an extra episode I've put on this week because since this new year has started, lots of people are asking me, what do we do? How do we cope in this period of lower capital growth? Because many investors, many people out there sending emails and doing seminars have never lived through this sort of period. Welcome to the new listeners and the returning listeners, because I want you to understand that there are two things you can do about the new norm. First of all, you can understand the new rules, learn how they work, learn how to work around them, and take advantage of the opportunities available in the current property market, because clearly there are some good opportunities. Or you could just wait and see what happens. Now, unfortunately, that's what many people are going to do. They're going to sit on the sidelines until they recognise this new reality is the reality, and they're finally going to take action. They're going to buy new houses, they're going to buy investments, but the market will have moved up a notch because of the action taken by the first group of people, the savvy investors. So how do you achieve capital growth in this new norm? Well, that's what I want to discuss today, and I'm going to do it in two parts. First of all, we're going to have a bit of a chat about some of the capital growth myths, so you'll really understand what will lead to capital growth in the new norm. Then I'm going to have a chat with Dr. Andrew Wilson, Australia's leading independent property economist, about what he sees ahead for 2018, and I'm going to share some of my views of what's ahead in 2018 as well. Now, apart from receiving my daily blog and getting these weekly podcasts, a great way that you can grasp what's ahead for 2018 and understand how you've got to set your sails, because you are going to have to set your sails differently because the winds are blowing differently. And if you don't want to be blown off track, you're going to have to set your sails to move forward for financial freedom. So once a year, I conduct a series of seminars around Australia, my national property market and economic updates. And I'm doing something I've never done before. As a listener to my podcast, I'm inviting you to join me as my guest. So for free. So go along to propertymarketupdate.com.au, put in the coupon code podcast, and you can join me as my guest. You'll get all the details there, and I'll be in Melbourne, Sydney, Brisbane and Perth. So, I'm with a group of experts too. So let's get on with today's show, where in two segments, we're going to discuss a bit about capital growth in the new norm. Clearly, we've moved into the next phase of the property cycle, one of lower capital growth in some locations, and in fact falling property prices in others. But that doesn't mean it's time to change your investment strategy. I still believe it's important to buy properties that are going to give you strong capital growth, because real wealth from real estate is achieved through long-term capital appreciation and the ability to refinance your properties and keep adding to your asset base. You're not going to become rich in real estate from rental income, because residential real estate isn't really a high yield investment. Now, there's no doubt that you need to have income to pay the mortgages, but if you focus on cash flow positive properties, you're going to struggle to grow a future cash machine from your property investments. It's just that simple. And if you think about it, when you retire, most of your wealth won't be money that you've saved. It won't be rent that you've earned. It's going to be the capital growth of your properties. That's why you've got to focus on that. But to ensure that you own the right type of properties that deliver capital growth, particularly in this lower growth environment, today I'd like to actually look at 6 myths about capital growth to make sure that you don't fall foul of them so you own the right sort of properties. The first myth I'd like to discuss with you is the concept that population growth leads to capital growth. Because it sort of does, but not completely. Let me explain. Our robust population growth clearly has underpinned the strength of our property markets, but that alone doesn't guarantee capital growth. You need to find the right areas where it's combined with affordability of properties. But by that I don't mean cheap properties, not that properties are cheap and therefore affordable, but areas where people have got higher disposable income and are able to afford them. And you also need to combine it with a favourable local property supply and demand ratio. Of course, population growth is important, but not on its own. It's got to have the right circumstances around it, affordability, in other words, high incomes, and the right supply and demand. The next myth is just invest in any capital city and you're going to experience strong capital growth. I mean, over the last couple of years, we know that Sydney and Melbourne have decoupled from the rest of Australia and outperformed. But there's not one Melbourne property market or one Sydney property market. Instead, there are multiple sub-markets based on geography, price point and type of property. And during the last years, despite the high growth, while some areas have outperformed, others haven't, meaning you can't just buy any property in these big capitals and assume it will outperform. Another myth is just buy land and it appreciates. But the fact is, not all land's created equal. Some suburbs are going to be more popular than others. Some areas will always have more scarcity than others, meaning over time some land will increase in value much more than other areas. Of course, these are the locations as a property investor that you should be targeting, as that's where you're going to get above average capital growth, and that's what you should be aiming at. You're never going to be able to predict exactly what the capital growth is going to be, but you want to get above averages, in other words, wealth producing rates of return. And as long as I've been investing, the argument has raged, well, where do I get those? Do I buy in regional Australia? Do I buy in capital cities? Do I buy in inner suburbs? Do I buy in outer suburbs? And there have been lots of studies, and over the last year or two, a rising tide's lifted all ships, so therefore outer suburbs, regional areas have all lifted up as well. But as the market now flattens, you're going to find that it's not going to continue on. In fact, they're the areas that are going to suffer more. So while there are always exceptions for overall strong, stable, long-term growth that's going to outperform the averages, in my mind, the inner and middle ring suburbs of our major capital cities are the places to invest. Look, let me put it another way. You can go to any other capital city in the world, I don't know, to London, Paris, Los Angeles, any other big capital city, and you're going to find that the wealthy people tend to live, 10, 15 minutes from the CBD, or they live near the water. And why is this so? Well, the cynics would say because they can afford to. And in part, that's true. In general, the more established suburbs with the better infrastructure, the better shopping, the amenities tend to be close to the CBD or close to the water. And that's where the wealthy want to, and they can afford to live. And of course, they're prepared to pay a premium to live there. Another driving force of capital growth in our inner and middle ring suburbs is their gentrification by affluent young families who are prepared to trade space for place. Some are happy to live in townhouses or renovated semis in modern accommodation but on compact blocks. And others are prepared to trade their backyards for balconies and live in apartments to be close to where the action is. So, yes, you need to invest in these sort of locations. And it's the land underneath the apartments, townhouses, semis in these locations that goes up. But not all land is created equal. Another myth I'd like to debunk right now is that you can predict capital growth. There's no shortage of experts who are trying to predict the next growth hotspot. And of course, there are all those online reports telling you how to get the next hotspot. Look, the fact is meteorologists tend to predict weather better than property commentators predict future capital growth. Now, this doesn't mean you shouldn't listen to the experts. You should, but you must also understand the level of accuracy of their predictions and take that into account when formulating your investment strategies. Another myth I want to debunk is that you're likely to get capital growth if you buy negatively geared properties. Now, it's true that high growth properties have relatively low yields and are likely to be negatively geared, But many negatively geared properties have experienced minimal, in fact no growth. Just look at all those off the plan inner city apartments that people bought. And that's because negative gearing isn't an investment strategy. It's just the way a property is financed at a particular point in time. So while you require strong capital growth to make up for the cash flow loss in negative gearing, that's not a given. You can't just buy negative geared property and hope it's going to go up in value. So all that depends on sound property selection. So I guess one of the things I've missed out on saying as I'm having this chat with you is it's important for you to buy investment grade properties. And if you're not really sure what an investment grade property is, go back to podcast number 1 where I go into that in a lot of detail. Another myth I want to debunk is the concept that new developments are good news for an area and are going to give capital growth. Many consider a new high-rise apartment block or the opening of a new housing estate as positive for local capital growth. And while they may lead to local population growth, and sometimes even a little bit of local economic growth as development occurs there, they often stifle long-term capital growth. Large high-rise apartments obviously distort the supply and demand ratio, and of course oversupply is not something we want as an investor. Similarly, in these new housing estates, often they're going to give a little bit of a short-term boost as workers go there and they help support the local shops, but in general they also lead to a local oversupply. And the demographic of people in a lot of these new housing estates, and it's no disrespect to them, but they're the younger families who in general stretch themselves financially, meaning these locations suffer most when interest rates rise because people take on large financial commitments, overstretch themselves for the home, then they, go to Harvey Norman or JB or Hi-Fi, one of those places, get one of those furniture and entertainment packages on 3 years interest-free, and all of a sudden their interest-free period expires and they suddenly find themselves with huge credit card debt. So, no, avoid the high-rise and the off-the-plan areas. So, I've actually busted a whole lot of myths on what doesn't cause capital growth. So what will cause capital growth moving forward? And in my mind, it's the 5 Ps. People, purchasing power, position, property and places. People, purchasing power, position, property and places. People, in other words, how many of us there are. It's not just population growth, but it's actually household formation. And more Australians are in the household formation age, and it's households who buy or rent properties. Purchasing power has nothing to do with affordability. It really, affordable or cheap properties. It really has to do with rising wages and the combination of what property values are and interest rates. The 3rd P is position. You know from my previous chats with you that location is a major factor in capital growth. The right property. The 4th P is getting an investment grade property in that right location. And the 5th places is really just supply and demand. How many places there are is related to supply and demand. So what drives capital growth? People, purchasing power, position, property and places. And I hope this isn't popping in the microphone as I say it, the 5 Ps of capital growth.
If you're looking to get started in property or to grow your existing portfolio, turn to someone you can trust for independent advice. The team at Metropole Property Strategists have been involved in over $2 billion worth of property transactions, creating wealth for their clients, and they can do the same for you. They don't sell property, so their advice is independent and unbiased. Metropole can devise a strategy, their buyer's agents will buy your property for you, or you could use their renovations team, property development or portfolio management services. Arrange a time for an obligation-free chat at metropole.com.au.
Before that short break, we had a chat about the 5 Ps of capital growth. Now I'm going to have a talk with Dr. Andrew Wilson, Australia's leading property economist, and talk a bit about what happened last year and what we together see is going to happen this year. By the way, Andrew Wilson is going to be at my National Property Market and Economic Updates, and you're going to be able to get a copy of all his research and the graphs about what's likely to be ahead. Remember that special deal. If you come along as a subscriber to my podcast, and I hope you do subscribe at iTunes or Stitcher, you can come along at no cost as my guest by putting in the coupon code podcast at propertymarketupdate.com.au. Well, it's really been finance that's slowed down this cycle as it has every other cycle, but rather than high interest rates, it's really been APRA's tightening the screws. Now that we're past the boom stage, what's likely to be ahead? I see a number of trends based on what's happened in previous post-boom periods. More stock's going to slowly come onto the market as more vendors move into the market. Some of them are still going to hope to get their sale happening before the markets slow down too much. Of course, there's also going to be thousands of new apartments being completed at the end of the construction boom. So first trend is more stock. The next trend is a reduced demand, particularly from investors. A lot of it's going to happen with overseas investors not being in the market as much either. There's a bit of less consumer confidence, and owner-occupiers are struggling with affordability. So at a time of increased stock, there's going to be less demand. What that means is that buyers remaining in the market are going to be choosier. They're going to have what I call a flight to quality. Given the improved supply, lots of choices, they're only going to choose investment-grade properties or A-grade homes. I think we're going to see auction clearance rates fall a bit, back to a more normal rate, and Andrew and I will discuss that in a moment. But price growth is going to continue, albeit at a slower pace, and particularly in the better suburbs of Melbourne and Sydney, and around Australia as well. I think Brisbane's going to have a really good year this year as well. Overall, there's a possibility of minor price corrections, but this would be healthy after a long period of unsustained capital growth, particularly in our major markets. So, in my mind, the bottom line is you shouldn't be distracted by all the headlines. Yeah, the boom's over, but there's lots of opportunities to make money in the good property markets in Australia, the three big capital cities, Melbourne, Sydney and Brisbane. So I'm now going to play a recording of a conversation I had with Dr. Andrew Wilson a couple of days ago. I apologise for the poor quality, but it was just a spur-of-the-moment chat because so many people are wondering what's going on, and I know in future sessions the recording quality will be better. So turn down your sensitivity meters because there's so much gold in my chat I had with Andrew Wilson. I'm pleased with chatting, Andrew, because over the last few years, there have been two groups of people. There's been the property pessimists. They've been warning us that our obsession with buying houses is going to end in tears, and it hasn't happened. They've come every year. Also, there was another group of people, Andrew, the hotspotters, leading us down the garden path. Yet each year, I know you've been presenting at my annual property market and economic updates for quite a few years, and I've been impressed, and I know the attendees have been, with the accuracy of your forecast.
Thank you.
So it'll be great to hear what you've got to say. How would you characterise 2017 with regard to property?
Well, look, I think we did see, Michael, clearly the dissipating energy of our housing markets, particularly the big two, the big one, I guess, Sydney, which has been a remarkable story over the last 5 years. We've seen double-figure prices growth in that Sydney market following sharp cuts to interest rates, and of course, low interest rates mean higher house prices, and there's really no great, rocket science background to housing market analytics. It is really about the cost of money, and that's why we did see housing markets generally start to dissipate, particularly the high energy markets through 2017, is because we didn't have that lower interest rate energy to drive markets that we've had over the previous 5 years. And I think we've really validated also in 2017 that we've entered into this new economic paradigm of low interest rates, low growth, particularly low inflation, and of course low incomes growth. And it has been a conundrum for policymakers right around the globe. And I think that once we've got right through that mining boom of previous years, which of course initiated higher rates for Australia when other countries were suffering from the GFC, once we've got through that process, we've started to join the rest of the world, or we have joined the rest of the world in this stagnant economic environment. And that, as I said, means lower interest rates into the future, and that will mean a much more, predictable level of prices growth for most capital city markets going forward.
I guess what that means is the way a lot of people made investment decisions in the past and the way a lot of people strategise things is not going to work as well in the future. We are in a new normal. I agree with you, Andrew. And that's one of the reasons I'm looking forward to having this much longer presentation with you at our annual National Property Market Updates around Australia. Did the market deliver any surprises to you in 2017, Andrew?
Well, look, I don't want to sound like I know it all or no, it didn't, or perhaps a touch of arrogance, but not really. I think that we were always due to see that dissipation of activity. I thought there was still a case perhaps for lower interest rates from the Reserve Bank through 2017. We really started the year with a lot of concerns over the jobs market. We were starting to see a real shakeout in full-time jobs growth. I still thought that required some stimulus. Of course, our interest rates remained and still are higher than most other advanced economies. And again, that reflects the strength of our economy through the GFC period.
Talking about interest rates, I think APRA has now done its job. It's done well in slowing down investor ability to get finance, and so APRA is probably going to now not loosen things yet. It's a bit too early, but probably not tighten things. And I agree with you, the Reserve Bank would have liked to stimulate our economy better. We're really a bit sluggish, wages growth is slow, but it's a bit scared to stimulate the property markets. So we know, though, that, you've said it in your own words, property investment or the property markets is really a game of finance with some real estate thrown in the middle. So what will happen in 2018, in my opinion, will have a lot to do with if the Reserve Bank does something, and we've sort of agreed it may not this year, and APRA does something, and we probably won't affect it either. I think people who are a bit worried that it's the end of the boom don't recognise that just because it's the end of the boom, property values aren't going to crash, they're not going to fall through the floor, and it's very likely we're going to finish 2018 with higher prices in many areas than we started the year. But there clearly is an increased stock on the market at the moment. I think some vendors are still hoping to get in before that final change in the market, and there's still lots of new apartments coming to completion. So while there's not lots of new permits, there's going to be quite a bit of stock coming onto the market, Andrew.
Well, look, we saw stock come into the market, apartment stock come into the market, Michael, in Sydney and Melbourne, and of course most capital cities through 2017. There's no doubt that the building boom in terms of approvals has peaked and passed. But as you suggested, there are completions now to come into the market. But look, we really didn't see a shakeout in prices, given there were higher volumes of apartments for sale in 2017.
But I can see in 2018 a reduction in investor demand. People are getting a little bit nervous. Interestingly, the recent Property Investor Sentiment Survey we put out together with your Investment Property magazine said that the readers of Property Update are still very keen to buy, and 51% were looking to buy an investment. And I think the savvy investors are going to recognise it's actually not a bad time when the heat's come out of the market a bit. Owner-occupiers are probably going to struggle a little bit with affordability, but what I've seen at this stage of the cycle in the past, Andrew, is a flight for quality. When there's more choice around, the fear of missing out isn't there as much, so people are going to be a little bit pickier than they were before.
No, I think we're going to see a stabilisation of the house price cycles generally, Michael. I think that'll also mean if we see less peaks and troughs in prices, we'll see less peaks and troughs in sentiment as well. I think buyers and sellers will become a lot more circumspect about the nature of our housing markets.
I think we're going to have some interesting headlines this year, Andrew, because auction clearance rates are falling, but people have forgotten that an auction clearance rate around 60% is probably a pretty normal market, and when they're in the 70s and the high 70s like we experienced over the last couple of years, particularly in Sydney and Melbourne, that's a booming market. So I'm not that concerned that auction clearance rates are dropping a bit.
Well, look, we've got to look more closely at the data, Michael. We need to look at the subsectors, the areas that perform differently, and clearly we had a differentiation in performances in both Melbourne and Sydney between regions and price ranges. We did see clearance rates well above 80% in Sydney's inner suburbs and well above 80% in Melbourne's outer suburbs. Now, that was offset by much lower clearance rates in Sydney's outer suburbs and Melbourne's inner suburbs. But I think that will converge in 2018. We will see clearance rates, as you suggested, below those aggregated rates in the high 70s in Melbourne and the low 70s in Sydney. So you've got to realise, Michael, that with very strong migration continuing, demand for housing will continue at least to put a floor under prices, particularly at the budget entry level of the market.
Well, I guess the bottom line is don't be distracted by all the headlines that are appearing and that are going to keep appearing. This year, people are going to be using the shock tactics. Gee, there were some amazing headlines at the end of last year about prices slumping when they drop 0.1% or things like that. But the media loves scaring us, doesn't it, Andrew?
Well, they do, Michael, but they've got to be very careful that they don't go to that well too often. And I think, readers are becoming a little bit cynical about some of the boom and bust headlines we've had over recent years.
Well, so even though the boom's over, there are still opportunities, but you've got to be more selective. You've got to buy investment-grade properties. You've got to do your research properly. And I think the other thing is you've got to take a long-term view. But property's always been a long-term investment, hasn't it, Andrew? But the last couple of years have... And I guess the news cycle and the instantaneous effect of everything on the internet has made people have a more short-term view, and that's not the way you should deal with investments.
Well, that's right, Michael. And of course, these things are exacerbated when we do have when periods of very strong prices growth. We had extraordinary growth in Sydney for 3-4 years, double-figure growth. Of course, it was almost like going to the casino and doubling up on your money on every bet, and it was almost a license to print money in a sense. But of course, it was driven by low and falling interest rates, the lowest interest rates in history. And now that that's passed and our interest rate cycle is clearly flattened out, those gains will certainly not be evident in the future, particularly at that level.
That's okay. We've lived through periods of slower growth, and it's still there's great opportunities. And it's also an opportunity to maybe manufacture some capital growth by doing renovations and development. Well, that's it for this week's show. I hope you got something out of it. There was so much content about what's going to create capital growth this year, plus my chat with Andrew Wilson, that I hope you take time to listen to it again. And if you enjoyed it, I'd like to ask you a favour. I'd like you to pass details of this show on to a couple of people. Either tell them about it, send them a link, click on Twitter or Facebook and tell some people about it, because this huge subscriber base that we've built, all the downloads we've had over the last 6 months since I started the show, is really motivating me, and I'm keen to keep giving you 1 or 2 shows a week over this year. You're going to get a regular show every Tuesday, and just like this one, there's going to be a couple of extras thrown in when something special comes up. I look forward to catching up with you again next week and being inside your ears.
Thanks for listening to this week's episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect and pass on their wealth through strategic property advice. If you got value from listening to this podcast, please leave us a review and we'll read it out on a future show. Just go to michaelyardneypodcast.com/review and it will take you over to iTunes, where you can enter a review and let us know what you think. We'd really appreciate it. If you don't already subscribe on iTunes or on your Android phone, you'll find us there as Michael Yardney Podcast. If you'd like to gain instant access to the show notes or a transcript of the show, head across to michaelyardneypodcast.com. Watch out for our show next week. You'll learn some new ideas about property investment, success and money in around 20 minutes.